Today we're going to have a look at Fibonacci retracements and how this can be applied to our trading setups. Cool, so first things first, what is a Fibonacci retracement? So Fibonacci retracement is a technical analysis tool that is calculated from the Fibonacci sequence. This is going to provide us with predictive levels of support and resistance within a trending market. So when applying a Fibonacci retracement, the first thing we need to make sure we are comfortable doing is outlining, is a market trending? And if it's trending, in which direction is it trending? So we have got a video on identifying market trends. Just a brief recap here. We have either got price in an uptrend, which is a succession of higher highs and higher lows, or we have got price in a downtrend, which is a succession of lower highs and lower lows. So within both of these trending markets, the ideal place to look to enter a position would be at a higher low for an uptrend, and it would be at a lower high for a downtrend. These are the areas where a Fibonacci retracement is going to provide us with predictive support and resistance levels. So we have got two main levels that I personally use when it comes to Fibonacci retracements. There are further levels that other people may well apply, but for me personally, these are the two main levels. We've got a 50% and we have got a 61.8%. What these are telling us is that if we are looking at a trending market, the extension of a prior move up is going to be 100%. So this move up here from the higher low up to the higher high, or from the lower high down to the lower low, this is going to be 100%. Now, within a trending market, we would normally expect to see this pullback retrace a certain percentage of that prior move up or that prior move down. And this is where the Fibonacci retracement comes in to help. We would generally expect to see these retracements come back either 50% of the prior move up or 61.8%. And that is going to provide us with a potential area where we are going to enter a long position in an uptrend or a short position in a downtrend. Now, these are going to be drawn slightly different within an uptrend or a downtrend. So for an uptrend, if we are looking to apply a Fibonacci retracement, we are going to draw this retracement from a previous higher low up to the current higher high, and we'll probably be drawing this as price is starting that retracement, as price has created the higher high and is starting a counter trend. Now, we'll draw this fib retracement from a previous higher low. So we'll take our first point of the retracement tool from the higher low, we'll draw it up to the higher high, pull it across, and this has now provided us with a buy area where we would expect price to pull into before it continues that uptrend. So that is providing us with the next potential higher low. So from the higher low up to the higher high, then providing us with the next potential higher low for price to continue off of. Now, when we're drawing this in a downtrend, we are going to be taking the exact same theory, but we are going to be drawing it from slightly different levels. For a downtrend, we're going to be taking our first point from the lower high, our second point to the lower low, and we'll pull this across, providing us with a potential sell zone. As price pulls back from the counter trend into this area, we are going to look to align our confluences, including levels of support and resistance, trend lines, price patterns, other secondary indicators to provide us with further confirmation of that reversal. Now, we'll be drawing it from the lower high to the lower low to provide us with the next potential for a lower high. That is where we'll look to enter this trade, and that is where we would expect this trend to then continue. So this is going to be how we look to draw these in an uptrend or a downtrend. Now let's have a look at some price examples. So this particular price example is on the DAX. This is the DAX on a 4-hour chart. And these fibs can be applied to any time frames, although I would generally recommend they are used on the time frame that you identify a trend on. So in this case, I'm identifying this as a downtrend, and the swings that I'm taking for this downtrend is my high down to a low, lower high, coming across through here, down to a lower low, up again to our lower high, and we are currently at the lower low of a trend. So we're going to have a look to see if these Fibonacci's have been respected throughout this trend. If I want to use a Fibonacci retracement on this current swing, and I would like to enter a trade through this next retracement, I need to make sure that price has been respecting these Fibonacci retracements on the previous swings. So that's what we're going to do. I'm going to go from this previous high down to the lower low, and I'm going to see has price respected either the 50% or the 61.8. So yeah, we can see here we had a very nice retracement back into the 50%, a very clear rejection, and as well as that, in terms of lining up confluences around that point, we can see we had a very nice head and shoulders price pattern form at this point. So we have a very nice level where prices pull back into for the trend continuation. We get a nice head and shoulders form, which provides us with a bearish reversal, and we can see price then continues that downtrend. So we can see in the first swing, this has been respected. Now let's go to the second swing to make sure that price is still using these, the market participants are still using these Fibonacci retracements from the previous lower high that we just entered the trade on, down to the new lower low, pull it across, and we can see again, prices pull back into that sell zone, in between the 61.8 and the 50, looking to enter a trade around this area. And again, we can see we have something of a head and shoulders formed at this point. Left shoulder, head, right shoulder, waiting for the breakout before we look to enter that trade. Alternatively, looking slightly closer, we can see we also have a spinning top and then a very bearish, large bearish candlestick, almost an engulfing. So we have lots of bearish confluences lining up at this point where we would like to see them. Now, we can see that these have been respected on the previous swings, so we are well within our rights to expect price to be respecting these on the next retracements. So let's go from the previous lower high down to the current lower low, pull this across, and this is now providing us with a potential sell zone for price to pull back into. If price makes its way up to here, we can start to look for other confluences, confirming that price is likely to reverse, and then we can look to enter a trade. So that is a Fibonacci retracement. As I said, if you are unsure on the trend identification, do check out our video on that. Cool, well, cheers everyone for watching, and do stay tuned for other videos.